Another very common trade we do in the interbank swap market is a spread trade, where this is basically a basis between U.S. Treasuries and interest rate swaps. Um, for the different sectors of the curve, these are the two different yield curves. So this is the Treasury curve, which is generally at a lower yield. Historically, it's been at a lower yield than swaps. Over the last couple of years, in the longer end, beyond 10 years, we kind of left that off right now for to avoid the confusion. That is actually inverted due to market reasons. Um, the reason we would trade swap spreads is really twofold. One is to focus particularly on the difference in the different curve sectors between these two curves, which is fairly minute. But the other major reason is it's actually the movement in those two is a lot less volatile. So suppose somebody wants to do an interest rate swap and they need to get an approval to get that done, but the market's moving all over the place, up and down. Their potential earnings are swinging by millions of dollars. They could do a treasury trade very quickly, get that trade on, hedge the majority of their risk. They want to move it into interest rate swaps because there's a greater correlation to whatever particular asset they're trying to hedge. So once they have the treasury trade on, they'll turn around and do a swap spread trade, basically taking the treasury trade, turning it into a swap, maintaining the greater, taking the greater volatility out with the delta risk or the market movement risk, and fine tuning it a little bit by turning it into a swap. This is just the dynamics of trading interest rate swap spreads. In this example, we have UBS, who they're paying fixed in this case. All right, so they're going to pay the fixed interest rate. It's going to be the swap rate that they're paying fixed on. On the other side, they're going to be buying the U.S. Treasury against it. So the swap spread that we trade, they call the headline spread, is the difference in the two rates, the swap rate minus the treasury yield, and it gives you the swap spread. So that's basically the dynamic, the benchmark that spreads trade under. You take the swap rate, subtract the treasury rate, and you get the swap spread. On the other side of that, just to work out the fixed and floating side of it, if you're paying fixed, you're going to be receiving 3-month LIBOR, the floating side on the other side. Against that, though, you are buying the treasury. You have to turn around and you have to fund your treasury. So unless you have a lot of cash on hand, which most people don't in trade swap spreads, you're going to finance that using the repo market. So if you want to look at a total all-in P&L on this trade, you'll net out your fixed rates, the swap spread, and you'll also net out your 3-month LIBOR versus the repo. And that'll give you a total P&L on it. This is just going the other way, where we're actually receiving fixed or selling the swap spread. In this case, we have Bank of America. They receive a fixed rate here. They sell the treasury, which is at this yield. The difference between the two produces the swap rate. The other way around, they're paying LIBOR in this case. They are short the treasury, so they need to fund that, and they're going to be paying the repo, the rate on the repo, which will net off against LIBOR. If you have any questions, please interrupt, by the way. Last page here is the counterparty report. This is how we manage our clients, and this isn't from our bank. We just kind of threw something together very quickly. Most banks have kind of a online system where you pull up your counterparty quickly, it gives you all the details. But these are the main points that are on these reports. First thing is your counterparty's name. Second thing is the ISDA agreement, which is the master agreement that Odie referred to before, which is governed by ISDA, which confirms things like netting and how payments are made, what certain definitions mean. The schedule date, generally this would refer to a CSA agreement, which is a collateral agreement, so that if all your swaps net out and somebody's significantly in the money, you may post collateral against that net position to make the other counterparty whole in case of a default. This is the credit rating and S&P rating. deal tenor would be the maximum maturity generally that you could do with your counterparty. So if IBM is doing a 30-year swap and we only have a 10-year line, we wouldn't be able to do that deal. Notional amount is the total amount of swaps that you can do with counterparties. Generally, this number, the credit limit associated with that number is significantly lower than the actual number itself. The difference between a swap and a bond is a counterparty has to come up with the full cash payment to basically buy the bond. In the case of a swap, the counterparty is really only online for the change in the mark to market. So generally, if you do a 10-year swap, say $100 million, the potential mark-to-market exposure on that might be only a tenth of that. You might be able to leverage up 10 to 1, which is one of the big benefits of doing swaps is the ability to leverage. So the actual credit that, say, TD would extend a counterparty doing a $100 million 10-year swap might only be $10 million. Or if they were going to buy a bond and we have to wait for payment, they would have to come up with $100 million.